Right, morning everybody. Welcome to our second webinar on retirement planning. Today joining me is Stuart Dyer. He's going to be doing the presenting. And then we've got a few questions afterwards. Just a little bit about us, Investonline. You know me, Nick Brummer, director, and the rest of our team on screen there. Team of 15 well-qualified financial advisors, CFPs. I'm a CA. Investonline is based in Newlands, Cape Town. We're independent financial advisors. The independence is really important. We do financial planning and investment advice. Hopefully this webinar is going to help you in your retirement planning, your thinking, and we have some questions afterwards which hopefully will be helpful. And thank you for submitting that. What we've done is we've taken them from people registering, and we've had between 40 and 50 questions. We've selected 7 or 8. Okay, thanks, Stuart. Yeah, over to you.
Morning, everyone. Today, thanks for joining. I know we had the first session yesterday where we went through do I have enough to retire? And that session was primarily with an emphasis around retirement funds, your pension funds, your RAs, and your decisions that you make when you're getting around retirement in those funds. Today, we're going to have things a little bit more broad. We're going to talk about retiring without formal retirement funds. So it doesn't mean that you can't have a pension or an RA, but I think the emphasis is on if you get to retirement and you have a variety of investment assets, or we see situations, someone sold a business, they've inherited money, they've sold properties, and now they are able to design their retirement plan. So that's really what we're going to focus on today. Our 3-pillar structure we like to do, and clients of ours will know that concept. Income structuring and tax efficiency. We're going to talk in quite a lot of detail about Section 10C, which is the Income Tax Act section around excess contributions, the tax rules around that, as well as we're going to talk about on death, the estate rules. And then, as Nick mentioned, we'll go through a Q&A session. We'll both tackle some questions. So just in terms of the reality for many retirees, I think we are seeing an increasing amount of people who are retiring that weren't necessarily working in the traditional corporate sense. Now they've got to retirement, they have retirement, they've got wealth to retire on, whether that's wealth from owning a business or anything else, but they don't have a set pension fund. So I like to think of it as they have a bit more of a blank canvas, and they can really design their plan any which way they feel appropriate. I think we see a lot of people maybe focus as a first step too much on the actual underlying investments, such as your shares, your ETFs, your funds. And where we want to really highlight is on the structuring. What investment vehicles or products should you use, and how should you draw your income? That's always, we call it the first layer of decision making that needs to be done. And I think because the money is generally all discretionary, there's no compulsory rules that are driving how you can manage your money or what products to use. And because of that, there is a higher risk of mistakes, because there are certain areas that can be overlooked, as I've just mentioned. So in our opinion, what one needs in this situation is a clear income plan, a sustainable drawdown rate. So if you remember yesterday, we went through modeling your living expenses on your basic expenses on a monthly basis by doing a retirement budget. And then also your capital goals, such as buying a car, traveling overseas. And you've got to work out how you're going to fund that throughout the rest of your retirement. You're going to have a strong investment structure. You've got to have tax-aware planning, and you've got to make sure your estate treatment is efficient. And I mean, Nick will attest to this. Those last 2 points, I don't think on purpose at all, but I think generally are overlooked until one gets later in life and they start paying a bit more attention to that. We think you must pay attention to that as early as you can. So the 3-pillar framework. It's just a term we've coined. Previously, we've called it the 3 buckets, but I know that There are some other income bucket strategies out there. So we're calling it the 3-pillar framework. So what that is to categorize your money, and this is primarily psychologically, into 3 different categories of types of investments. The one is your local retirement funds. It's quite straightforward. Any money you've got in RAs, living annuities, pension or provident funds or preservation funds. What's the purpose of this area? This, as one knows, retirement funds are very tax efficient on growth. You don't pay tax on as the money accumulates and grows. And ultimately, when you start and you get to retirement, you start drawing a regular income from these funds. The second pillar, what we call your local discretionary, which is now voluntary money that you've chosen to invest. This would be within South Africa. And often this might be a smaller percentage of your portfolio that you would put in local money markets, local trusts, local cash accounts. Sorry, I said trusts, I meant unit trusts. If you've got a share portfolio in South Africa, or what's also in here is tax-free investments. Any local investments that you can tap into to withdraw money out of. And that's essentially what we call a local discretionary. And then your direct offshore. And we've spoken a lot in our other presentations as well as in our newsletters about the importance of having money directly offshore outside of South Africa, where it fits into a plan. We're not here telling individuals to take all their money offshore, but when you retire, it definitely makes sense to have a percentage of your wealth offshore. Ordinarily, if you're a South African resident, we have given all the benefits around offshore wrappers. And what forms part of that offshore pillar can be if you've got any foreign shares, if you've got offshore wrapper, if you've got any offshore platform accounts or unit trusts. And the purpose there is to grow your money in global terms. Generally, offshore money is very tax efficient on growth, as well as to protect against SA-specific risks, and that's really around SA inflation. Just in practice, how does this 3-pillar framework line up is what makes sense is to skew certain types of investment assets into different types of investment accounts. So in the case of this picture, what you can see is we have this client's local retirement funds, which might be a living annuity. We have that position more conservatively. You can see the dark purple section is equity, so shares. And then the light lavender colored section, that's cash and bonds. And the reason one would do that is that in a living annuity, you don't pay tax on what you earn in an investment, how the investment grows. You only pay tax on what you draw out. So in theory, you could have a living annuity earning 10% interest, and that could be considered interest income. You don't pay tax on that 10% interest income. And if you draw an income of 4%, you only pay tax on the 4% you withdraw. Whereas we all know if you earn interest income in a unit trust account or a money market account at the bank, you pay full tax on the interest that's earned, regardless of how much you actually withdraw. So interest income is something where tax is paid as it's earned, not when it's used. So it makes sense to skew lower risk assets to a living annuity and to have a little bit more risk in your local discretionary money as well as your direct offshore money. Now, directly offshore, we all know the stock market generally gives you a better yield than your cash and bonds offshore. And that's why in this sort of plan, we would skew the investor more into equities, where they may have 70% or so of the offshore portfolio would be in equities in this example. The key thing is we look at everything holistically. So for the overall plan, you might have half your money in shares and half your money in cash and bonds. You might have half your money locally and half your money offshore. And it's just about how we cut it up that really can save you from a tax perspective. And that's why we look at it in this 3-pillar manner. So just to get into the income and tax, what does income structuring actually do? What it does is it creates income predictability. If you know exactly how much income you're going to draw from your different products and how those products can escalate your income, You can have good visibility over the longer term, not just the shorter term. Let's say you invest into a fixed deposit that's giving you a 9% income for a year. Now that year is over and interest rates have dropped from 9% to 7.5%. Now your income's decreased because you're in a lower rate environment. So when you've got a proper income structure, you can have predictable income. As we just showed you in the 3-pillar structure, you can lower your annual tax burden. Having a good structure can reduce the sequence of returns risk. So what is this concept? This is a concept that there's been quite a lot of studies on. And this just says when you retire, there's a big element of your success in retirement actually depends on how well you do performance-wise in your first 2 or 3 years. So if you take on too little risk and you don't beat inflation in your first 2 or 3 years, your retirement can be far worse off. The same way, if you take on too much risk and you lose a large amount of capital in the first 2 or 3 years, let's say you invest right when there's a market correction, then that can really hurt you, because when you start drawing into your capital, you don't have enough number of years to make up that capital again if you start living off of the money. So it's very important to have the right risk in your different products and to draw your income correctly to avoid an event, whether it's a stock market event or change in interest rates, really negatively affecting your retirement plan. And then as a result of this, if you get all these things right, you can extend the longevity of your portfolio. So what tools are available to you to help you do tax planning around your retirement? Is you get your tax exemptions that you get. The one example is your interest income exemption. You're allowed 23,800 or 34,500 if you're over 65, that you're allowed to earn an interest before you pay tax. So it's important to take advantage of those. And normally people would do that by keeping some money market funds aside. To plan your CGT, remember, a lot of people just let their investments grow, and rightly so. But if you don't trigger any capital gains for 10 years, sometimes we see 20 years, where investments just grow for a long period of time, ultimately that capital gain that you're leaving what's called unrealized, that you're not triggering, it just gets larger and larger and larger. So when you then end up selling that asset or that share or that fund, you have a much larger rand value that now is going to be taxed as a capital gain when you do that transaction. So that bigger capital gain can push you into higher tax brackets potentially. So it's just important to make sure you do trigger gains strategically. You can do some strategizing around using, between February and March, you can do 2 different tax years and try and make sure you plan your CGT accurately. Spousal structuring, if you are married and you do consider your assets to be or your retirement plan to be a joint retirement plan, as you can split your investments quite cleverly amongst spouses. We've even seen clients of ours that may put some money in a living annuity for their spouse so that they can draw a tax-free or tax-efficient income to help them then draw lower income from their living annuity. So there are a lot of things that can be done there. And then offshore tax efficiency. As I've mentioned, we have good interest rates in South Africa, but interest income's not a tax-efficient type of investment class, especially when you get to larger amounts of money. If you're talking about investing millions of rands into money markets and income funds, then the income you're earning does become taxable and can be taxed at 30% all the way up to 45%. So where offshore funds are generally more tax efficient is you're only paying capital gains tax. The benefit of paying capital gains tax is you only pay tax when you sell an investment. You don't pay tax as the income is earned. And that just means that you are delaying having to reduce the value of your investments by the tax that's needing to be funded all the time. So it's important to consider offshore investing when you're doing your tax planning. This is a table. This is an example of a table we would do for clients of ours, and clients on the meeting might recognize this format. Is to look at your different investment accounts. Often, what could happen is we might look at the accounts that you have, do a restructure for you, and come out with a recommended new structure such as this. And if we just look at this couple would have the living annuity in the name of the husband, living annuity name in the name of the wife. They have some money that we'd recommend that they keep back in unit trusts and cash. And often that would be to fund capital goals that I've mentioned, car purchases, holidays, and things like that. And then your offshore money that you would have directly offshore. And then how you draw your income, because you're splitting your income ultimately between a living annuity and the husband, where you pay as you earn tax, living annuity in the wife, where you pay as you earn tax. Now, it doesn't matter if you're married in community of property. Living annuity income is taxed the same as a salary. Each individual pays their own tax on the income that they draw. So I know quite a lot of people might have really sizable retirement funds, and then they get to retirement and they ask us, can I give some of this to my spouse? And you can't, because a retirement fund is an individual investment that you've saved up for, and the only way it can get out of your name is if you pass away or if you get divorced, which I don't think are things we want to plan for in this retirement planning. And then your unit trusts in your cash. Now, this can be shared equally amongst each other, amongst spouses. If you're married in community of property, it would automatically be 50-50. Or we can do it strategically that we skew it towards one spouse rather than the other, depending on who's got a lower tax rate. And across the whole plan, you can see that they're drawing 105,000 Rand a month before tax, comes out at close to 90,000 Rand or 91,000 Rand after tax. And they're paying an effective tax rate on income of 13.6%. So as an effective tax rate on the amount of capital that they have, which is 35 million Rand, it's a very good tax rate that they're actually managing to maintain there on the income. Now, just to say that there will also be income on capital gains in the unit trusts and the offshore wrapper. That's not indicated here, but if that's structured correctly, those capital gains can also be limited to around 12, 13, 14% and also be kept at a good rate. So in practice, just to go through the concept again of the different products and what the purpose of them are. So with your living annuity, that's really to provide you with regular income, tax-free growth, and you're allowed beneficiaries in the living annuity, which is very important. So the living annuity process doesn't involve your estate. Your living annuity can pass to your beneficiaries very easily. Your local unit trusts or your money markets, whatever it might be, that's your local discretionary investment. That's there to top up your income if you need to, such as the past slide where they took 30,000 Rand from the unit trust. The reason they did that was to stop them having to take more from the living annuity, which would push both of them into higher tax brackets. So keep the living annuity income reasonable so you stay in a reasonably low tax bracket. The local unit trust can also be used to fund bigger goals like travel and bucket list goals. And then your offshore wrapper, touched on it a little bit earlier. That's really there to make sure you've got money in foreign currency, you're growing your money in global terms. It's completely very tax efficient. And the big thing, if you put your offshore money in an offshore wrapper, is you allow beneficiary nominations, and your beneficiaries can inherit that money offshore in foreign currency, or with SARS approval. It's very, very efficient to do it. I mean, it's really, really smooth process. We've done it for some clients. So if you're interested in the offshore wrapper in particular, we did do a special webinar around that, where there was a lot of interest in that investment vehicle. So we're happy to chat to anyone who wants any more information around the offshore wrapper. And now I think this is a really written about and spoken about concept. Section 10C isn't a new thing. It's basically a section of the Income Tax Act, but it's been getting a lot more attention lately. It's something we've used in places over the last 7 or 8 years. I think there are good scenarios where taking advantage of Section 10C makes sense. And what we'll touch on in a few slides' time is the drawbacks to consider to make sure you have all the information when making these decisions. So what is Section 10C? So that it's the section of the Income Tax Act that governs excess contributions. Excess contributions are contributions that you've made in cash, capital, premiums to a retirement fund that you haven't claimed a tax deduction for. So normally if you've put more money in then you're allowed to claim as a tax deduction, that gets tracked by SARS and that gets labeled as an excess contribution. So everyone has an excess contributions line item that SARS keeps for them and tracking their contributions over time. So a lot of people won't have excess contributions if you haven't been contributing over and above what you can claim as a deduction. But what a lot of people are doing now is they're strategically placing large lump sums into retirement funds when they retire to take advantage of the excess contributions tax treatment that we'll go through. So as I've just mentioned, SARS tracks it for future tax benefits. Now, how are those excess contributions, or how do they reduce your future tax? So essentially, you've got your different times and different ways that you can access your retirement fund, and your excess contribution will apply in whichever one of these you choose to do. So the first one is your tax-free lump sum at retirement. If you get to retirement and you retire from your fund, and let's just say you've got R1 million of excess contributions, you can take R1 million from your retirement fund, and that R1 million does not get applied to the retirement tax table. That R1 million is considered excess contributions, and you can draw that out tax-free. So that's one way you can make use of the excess contributions, is to take them immediately when you retire. The other way, if you don't want to do that, is you can roll that excess contributions over into your pension. So it can roll over into a living annuity or a life annuity. And how it works in practice is that you would be getting an income from your pension, and you would get refunded by SARS for the tax that you pay on that pension income. So you would pay your tax as per normal, but every year when you do your tax return, SARS would refund you for the value that is considered excess contributions. So your pot of excess contributions reduces over time. As you use you draw that amount of income over the years, your excess contributions gets used and might draw down to zero while you're still alive. This is a good practical chart that we've drawn up to illustrate this. So let's just go right to the left-hand side of the chart. We've got 10 million rand. And in this case, the 10 million rand has been funded by excess contribution. So because there's a bit of a tax deduction in the first year, most of that 10 million rand rolls over as excess contributions now into your living annuity. So you can see that the gray area is the value of the living annuity that grows substantially over time. And that lavender purple area, that's the value of your excess contributions. So your excess contributions starts at close to 10 million rand, and over around 12, 13 years, you've essentially drawn all of that portion of excess contributions out and depleted those excess contributions that you had. Now your income, which is the dark blue line, it starts and it goes up every year. This is your income after tax. So what we've said is, because you are getting refunded for your tax, your after-tax income in those first 13 years is actually higher, because you're getting refunds for the tax that you should have paid. And then when your excess contributions is run out, now all the money in the fund is fully taxable as per normal now. You've taken cash, you've put it into a living annuity, you've enjoyed 13 years of tax-free income, but now the excess contributions is run out, and now the living annuity is at what? Close to 17 million rands value. It goes up as high as over 20 million rand. But now that full 20 million rand is taxable as per normal, because the excess contributions have run out. So there you can see now you're just having to pay tax again on your income as per normal. So In this case, I think it's a good outcome for the individual. They've enjoyed 13 years of tax-free income or getting refunds on their income, and then they've been able to delay their tax on the income by about 13 years or so. And then I know there's a lot of uncertainty around the treatment of these excess contributions on death. There's uncertainty for good reason, because SARS have given different opinions over the years, and it's quite clear now how SARS is going to treat these excess contributions on death, and it really depends on how the money is used on death that affects the tax treatment. So a big thing to realize is that the tax-free nature of that income that I just showed you, that only applies to the original member, what they call the original annuitant. If you pass away and someone takes over that pension or that living annuity, that income, that excess contribution falls away. The person who inherits that money does not get to keep enjoying tax-free income. They would be taxed on the income in their own name as per normal. So the tax-free allowance does not pass to beneficiaries if the living annuity is kept. Now, what is the impact for beneficiaries? So as I've just mentioned, if you continue the living annuity, if the beneficiaries choose to continue the living annuity, the excess contributions are excluded from the deceased estate, reducing estate duty. So because you've put money into the living annuity, let's say you've passed away at age 70 now, that capital is still growing and there's excess contributions left. The beneficiary has taken over the living annuity now and they are drawing an income in their own right. There's no estate duty on that transfer because living annuities are not subject to estate duty. So ultimately where SARS is getting their tax is not on the estate tax, which is called estate duty. They're getting their tax from the new individual that takes over the annuity in the form of the income they're going to draw. Now, on the income tax perspective, beneficiaries receive the annuity income fully taxable in their own hands. So in the case of that previous person who I said they put 10 million rand into the living annuity that was cash, if they passed away a day later and a beneficiary took over the living annuity, all of that would be taxable as income because those excess contributions don't roll over. Now, when the beneficiary inherits the money or gets the beneficiary nomination, they can choose to take a lump sum instead of taking a living annuity. Now, this is where it gets a little bit complex. If they take a lump sum, the estate treatment changes. If you take a lump sum, you can take the lump sum and the excess contributions can be withdrawn as tax-free cash. So the person who's the beneficiary can take the money as a lump sum and the value that the excess contribution sits at can be drawn tax-free. However, the effect for the person's estate who passed away is now that the value of those excess contributions is considered a deemed asset for estate duty. So you can see you can get a tax-free lump sum on the terms of retirement rules, but the person's estate will still have to pay estate duty. So you don't get around the estate duty if the beneficiary takes the lump sum. So that's quite a big risk to the investor because your estate could be having to pay estate duty where maybe they haven't planned for the estate duty because they thought the beneficiary was going to take a living annuity. So as you can see, it's quite complex, this Section 10C on death, and we're happy to consult with anyone around their particular case if they've got questions around this. So just in summary on Section 10C, and then before we move back to Nick with some questions, is what are the key drawbacks to consider? If you are someone who's considering putting large amounts of capital, taking R1 million, 10 million rand, whatever it is, and putting it into an RA to then convert to a living annuity, a lot of the articles that have been written are saying to basically get away from estate duty. These are the drawbacks we just want to highlight, is that when you do that, you're taking money that is discretionary money, voluntary money, flexible money, and you're putting it into a compulsory product. A living annuity is a compulsory product. It can't be withdrawn as a lump sum. So you have to, now you're restricted to the particular rules of the living annuity. The income limits apply. which means you're restricted to 2.5% all the way to 17.5% in withdrawals that you can do each year. So that reduces flexibility compared to if you just had the money in cash. As we've just gone through in detail, the 10C benefit ends at death. So your beneficiaries can decide whether to take a lump sum or to continue the annuity. They ultimately have that choice. So you can't direct the outcome as precisely that you could if you used a will or even if you used a trust, where you can be a little bit more prescriptive around what the beneficiaries would do with the money. And the beneficiary choice is uncontrollable. So, thanks, Nick. No, a little bit complicated at the end there. Yeah, but happy to take your questions.
Good. Well done, Stuart. That does get quite technical. And thanks for that. In any case, let's go through a few questions. First one, tax optimization in retirement. Can you give us some examples of how to withdraw income and from where, like an annuity, tax-free saving, discretionary investments, etc.?
Yeah, I think we've covered that a little bit in the three pillars that we presented, Nick. I think what I would say is certain investment products that we consider as last sort of option to withdraw money from would be if you've got money directly offshore and you don't need to draw from it. That shouldn't be part of your immediate income plan. If you've got a tax-free investment and you've got sufficient other income, I wouldn't touch the tax-free investment for as long as possible. So ultimately, you want to have the right mix of income between your annuity and your discretionary investments. Now, that is really case by case, depending on how much of your wealth is in annuities, how much of your wealth is in discretionary investments, and what your tax rate is. So we would have to design a plan depending on that. But it's just about getting that right structure across those three pillars.
Right, thanks. All right, thanks. Should I live off the cash for the first few years of retirement and delay using my pension?
Yeah, this is something we get asked a lot. I think that people have the right intention where they retire from their fund and they have this thought of, well, I want to let the fund grow for as long as possible. So I'm going to defer it for 2-3 years because I've got $1 million or $2 million that I've got it sitting just in cash. Especially if you've been given a severance benefit, maybe you're considering living off that instead of using your fund. Once again, Nick, it's a case-by-case situation. I think if your fund is a meaningful portion of your wealth, your pension money is 60, 70, 80% of your wealth. If your discretionary capital and your cash is a smaller portion, I would definitely consider using your retirement fund immediately, even if you just draw the minimum income you can. Because actually the biggest risk in retirement is not your money running out. It's not having enough access to money when you need it. So like I've shown you the goals, I've shown you the liquidity constraints. In yesterday's thing, we saw someone had 40 million Rand, but they had a liquidity problem in 15 years. So you've got a plan that you're going to have enough liquid money. So I'm generally prefer to advise people use your pension fund and preserve your liquid savings. But it does depend on how big your pension fund or your retirement fund is as a percentage of your money.
Yeah, thanks. Right, back to 10C again. Will you pay state duty on 10C, excess contributions?
Yeah, so I covered that in the slides, but I don't know how absorbable it was, so I'll just answer it again. So if the beneficiary of a living annuity, so if you've got Section 10C that rolls over, either if it's either in a pension fund or in a living annuity, and now you pass away while you've still got excess contributions that you haven't used, and now there's a beneficiary that gets the right of what they want to do with that fund, whether that's a pension fund or living annuity. If the beneficiary draws the excess contributions as a cash lump sum, there's no retirement tax, but you pay state duty. The person's estate of who put the money into the fund is going to pay state duty on the excess contributions because it's going to be called a deemed asset. So that's the thing SARS has done that's caught a lot of people off guard. as they've clarified how that's going to be treated. If the beneficiary takes the money in a living annuity, then there's no estate duty because the beneficiary is going to continue drawing an income from the fund in their own right. So that's the repeat of the answer, just to make it crystal clear.
Okay, good. All right. How should I start structuring my retirement savings for immigration? Into Europe.
Sure. This is quite broad. I think once again it depends on what your starting situation is. I think if you've got formal retirement funds, you want to consider stopping to contribute to those if you know you're definitely going to leave. I mean, you can withdraw retirement funds when you stop being an SA resident. The current rules is that you have to cease to be a South African tax resident, live overseas for 3 years, and then you're able to apply to withdraw your retirement funds. So I definitely think that's quite a process. So if I knew I was definitely going to leave, I would try and reduce or stop my contributions to pension funds and retirement annuities. If you don't have pension funds, then you can invest as much as you're able to offshore already. Your future wealth won't be linked to South Africa, so you can use your clearances. You're allowed to take R1 million without any tax clearance, or another 10 million rand with tax clearance. And depending on where you're going to move, you can either use a wrapper or just open a normal platform account, and we're happy to have those discussions with you. There's different countries where the wrapper makes sense and some countries where the wrapper won't make sense depending on where you're going to move. So I think that's a good starting point.
Good. Right. Can an RA be taken at the time of retirement with intention of using it as a vehicle to reduce taxes on one's pension withdrawn?
Yes, so you can. And quite a lot, we see people do this as a tax planning strategy. There's actually no maximum entry age for a retirement annuity, so you can keep opening new RAs and retiring from them, and you're basically rolling cash out of a living annuity into an RA, back into a living annuity, back into an RA to keep being tax efficient. You can get quite detailed about it if you want to. And then, like we've mentioned, even if you want to do more capital than just to give yourself a tax deduction in that tax year, but if you want to use the excess contributions benefit, you can put large amounts of capital into retirement annuities and living annuities, and we are seeing people are doing that.
All right, thanks. Right, can I move my investments just before I die to an RA or living annuity? And by doing so, avoid estate duty.
And that's what the current tax guidance is actually saying, is that you can do this. I think for us as financial planners, you've always got to ask the question, if something looks too good to be true, where, especially from a tax perspective, where is SARS getting their tax? So the logic here is, let's just say you've got discretionary money, cash or unit trusts or whatever it may be. Now you're going to put it into an RA, immediately convert that RA to a living annuity, and you're going to tell your beneficiaries they mustn't draw it as cash. They must take it as living annuities in their own hands. So they are ultimately going to take over the pension, the living annuity pension. Now, if you do that, you avoid estate duty because the excess contributions roll over. But now you've put the money into a retirement product where those beneficiaries are going to pay tax on the income they draw. And depending on if they're South African tax residents, their tax rates, that income can be up to 45%. So SARS is always going to get their tax somewhere. So yes, you can avoid estate duty by doing that. You can legally do it, but SARS will get their tax, and that as the new beneficiaries withdraw the monies, the income from the living annuities, SARS gets their pay as you earn on those income withdrawals.
Right, last one. Should I start a trust for my family to use for retirement and save estate costs such as estate duty?
Yeah, I think, Nick, you'll know we do a lot of meetings around trusts, and we have clients who have trusts. Not too many clients starting new trusts anymore because SARS have made it more expensive to open trusts, expensive in terms of tax, to loan or donate money to trusts. But there are definitely scenarios where trusts make sense. I think where trusts do make sense is where you've got fixed properties, if you've got shares in companies or private company that you have, your own personal company, and different scenarios. But ultimately, if you've got enough wealth that you're not going to be able to reduce your wealth in your lifetime, and that wealth's just going to keep growing and growing and growing, potentially for your lifetime, children's lifetimes and grandchildren's lifetimes, then it's definitely worth looking at a trust. Because what a trust does is it helps to, it helps to manage estate duty and how much of your wealth is subject to estate duty on the passing from one individual to another through the generations. So that's why trusts are often used if you've got larger estates where the capital is going to continue to grow. But in my opinion, if you are, I would say, someone where you've got your amount of money that's probably going to fund your lifestyle, and you might deplete that money into your 80s and 90s, and at some point it's going to start going like this, then I think a trust can just complicate things. And often, as I've mentioned, trusts are also costly. So I think talk to us, and we're happy to give you an opinion on whether a trust can add value or not to your situation.
Good, well done. Yeah, well done, Stuart. Some tough questions there, well answered. Listen to the audience out there. If you're not sure and you want us to go over them again, please feel free to reach out to us and we'll assist you. And just to go and just remind you of our core services of the financial planning we do. Again, I always reiterate, let us do a financial plan for you. It's going to give you great visibility of how long your money's going to last, how much your lifestyle is going to be determined by your financial plan. I really highly recommend one does one. With that, goes hand in hand is investment management. So we do investment management to ensure that you have the right investment strategy and that your assets are positioned correctly in the right funds for the right environment. And a lot of that in terms of our track record we have on our website. You can have a look at our website, and obviously I manage a separate fund called the Prosperity Fund, which is really our in-house view of our investment thoughts. Also, direct offshore investing, forming a very critical pillar in what we spoke about in terms of the tax structuring. So direct offshore is everybody should have a portion. We spoke about investing it in a wrapper. We've done wrapper webinars. Look on the website. You can have a look at those webinars. But that's a critical part of the overall, let's call it, investment structure. And with that, it all overlays with the tax structuring of putting your investments into different products, because those different products are taxed differently. And if you do it correctly with the right asset allocation, you can have quite a meaningful saving over time. And we do a lot of that. So our value add, a qualified team that works together. We're very much team-based with investment experience, backed with a proven track record, as I've said. A lot of that is backed by happy clients. Prosperity Fund has done exceptionally well over time, so we have a proven track record in investments. Our whole process is transparent, cost-effective. We understand that's really important. Clear view of fees, so you really understand what you're paying for. A personalized service, an admin. There's always somebody here to help you. And then lastly, we have regular review meetings. We're very strict on that. Quarterly meetings with clients. We're always available, so it doesn't only have to be on a quarterly basis. Anytime you can contact us and we're available. And just to go through how our engagement process starts, we have an initial engagement with the clients to understand your needs and goals. Then we'll actually do a retirement assessment and effectively just go through all we've done in the last 2 webinars, evaluate your retirement readiness. Part of that will be doing a financial plan. We'll do a portfolio analysis, and that's really important. Look at your investments, do a look through, consolidated analysis, look at the fees, and then with that, incorporate that into a proposal for you, and with that, give you the best tax structuring and the right retirement plan that suits you. Right, that's us. Thank you very much for joining us again. Please go onto our website, look at our other webinars. We will be sending this out there. And Stuart, well done, well presented, well answered. And to everybody out there, thank you very much for joining us. Cheers. Bye-bye.